Right. So, Julie, really the bigger concern then becomes if there's an earnings recession, because you don't really have the response that you get from an economic recession on the part of the Federal Reserve.
I think that's absolutely right. I think that is probably the biggest near-term risk is what is going to happen to earnings given the pressure that we're seeing in terms of tariffs and, other economic factors too. This was like a long stage of a economic recovery and growth, but how sustainable is that? It's not very sustainable when you're dependent on 7 companies to really outperform. And so when I think about the opportunity for earnings growth from here, it really is difficult to do any kind of forecasting. And for us at Kayne, that's okay because so much of our analysis is really rooted in the qualitative aspects of the business. But for most investors on Wall Street, most of their analysis is really rooted in the quantitative, and the ability to do any kind of forecasting has really gone out the window. I think the other thing that's important is thinking about valuations. That's what's making it really difficult to do any kind of investment decision is you don't have a lot of clarity on the earnings growth going forward.
Well, when you think about valuation, and I remember the call we did in the prior quarter, you had mentioned some concern about where are for valuation. We've had a reset. I mean, look, this is a garden variety correction. It feels worse because this happened so fast. But where do you think we are? Obviously, valuations have reset lower. Are you comfortable where they are now, or do you think potentially there's more multiple contraction ahead?
Yeah, so I think if we look at valuations, it's important to distinguish between who we're talking about. And so as we saw, the thing that got all of us concerned in the last 2 years of having the market driven by only a handful of stocks is we all recognize that that is not a stable market that we can really rely on. And we're on the backside of that. And it's kind of exactly what we were worried about. So most of the correction is really happening in that Magnificent Seven stocks. You're seeing it also within the S&P 500, but it's to a much lesser degree than what we saw in the things that really drove us higher. If I think about, though, where the average stock is, we've moved away from being kind of in that higher 1 to 2 standard deviations valuation, and we're more trending towards what are long run averages in terms of valuations. And so I'm relatively comfortable in terms of thinking about valuations. But again, that assumes that earnings estimates really hang in there. And I think that's the part that people feel the least confident about. What I think is important if you're any kind of an investor, long-term or otherwise, is that you're recognizing that there is that level of uncertainty. And so now is not the time to be really chasing a lot of high multiple stocks. I think that's where you can be really in trouble.
Yeah, we like that word quality once again, finally, after ignoring it for several years. Julie, let me turn to you for a second. And if we could, when you think about the tariffs and the potential effect of the tariffs, they've been characterized as being potentially inflationary over the long run. Now, my perspective is that, yeah, there's definitely that one-time price shock from the introduction of tariffs. But you would have to believe that there is this inelasticity on the part of consumers to just continue to purchase goods and services as price rises. And given the climate that we're in now, I think you could extrapolate that further and say, well, are corporations going to continue to spend? Is CapEx going to remain relevant? So how do you think about that critical element of continued consumer and corporate spending as we kind of navigate through this elevated tariff environment?
Yeah, I think it's probably the most central and relevant point, right? Because we can all sit here and say, okay, think of tariffs as a one-time tax increase, and it should really be one-time in nature and in terms of its impact on inflation. And that can be true, but what can also be true is that consumers have really kind of reached their limit of what they're willing to do in terms of higher prices, especially across their core goods, especially for the low-income consumer. And so I think that's a a pretty fair concern that a lot of investors have in terms of the health and strength of the consumer, because that's really what has powered us through the last decade, right? It's anytime you have counted out the US consumer, they have come back stronger and more able to buy cheap goods, TVs, what have you. And so I think that it's pretty natural to be concerned about the level of prices, even if it's not, even if it doesn't continue, right? Even if the trade war doesn't happen and we don't get a cycling up of prices, we're still at absolute levels and we still have a population that is asking for price declines. And I think that's not on the horizon, regardless of what happens with the trade situation. If I think about the business side, we had so much strong CapEx investment over the last kind of 2 or 3 years. A lot of that was driven by AI, but a lot of it too was, the Biden administration trying to really invest internally to kind of drum up support for a lot of the policy initiatives that they had in place. You also saw companies feeling more courageous in terms of expansion plans and being willing to step into more capacity internally. When I look at business confidence surveys, I've really seen a big decline in the willingness to invest. And I think that that has long run impacts that I worry about, because part of the challenge with the tariff agenda is we don't have clarity in terms of what are the short-term goals and what are the long-term goals. And when I see a decline in CapEx, intention to invest in CapEx that's this large over such a short period of time, you realize that if you're a CFO right now, you don't actually have a lot of incentive to be spending in terms of your CapEx, right? You really want to keep as much optionality as possible. And everyone kind of agrees that having the flexibility to make changes and adapt based on policy is pretty central. So I think at least in the short term, you're going to see companies really paring back the amount of CapEx growth that they have in their forecasts. And that does have an impact. It has a real ripple impact in terms of business confidence, hiring, and even consumer confidence too.
So is it safe to say you think that, earnings expectations are more a moving target? I mean, especially no one's giving guidance right now, or, in the case of United Airlines, they're giving two different sets of guidance, right? Here's scenario A, here's scenario B.
I think we are entering a period of incredibly creative guidance expected. I think we're gonna see some innovation in terms of how companies decide to issue guidance, because it really is a situation where if the cone of outcomes is so wide because there's no policy clarity, what people I think are either going to do is issue no guidance, or they're going to probably make it so wide that you could drive a truck through and it's not really that relevant or useful. And for most investors who are very connected and tied to the quantitative metrics in order to drive their investment cases, that's going to be really challenging for them. That's going to be a loss of confidence for, I think, a lot of investors. The real thing is that you can't blame them when they have so little clarity on how they're going to sell their goods, who they're going to sell their goods to. Are we going to have reciprocal tariffs? Like, you can't blame these companies for wanting to be able to, put their hands up and say, I don't know. But I think that there is the potential for them to get punished for that.
Yeah, and that's such a good point. It's almost like, why even give the guidance? And candidly, we're doing quarterly earnings in an environment where it's rather difficult to be doing that, and it calls into question why we even do quarterly earnings. But I guess that's for another call or another conversation. Julie, I guess, conceptually, if you think about the challenge of tariffs and the small cap asset class, it gets a little complicated thinking about, well, potentially, how are they affected? Are they more immune maybe to some of the multinationals? They clearly have an economic sensitivity to the overall environment. So if you would just kind of educate us a little bit of how tariffs actually impact small cap asset class.
Yeah, so I'm going to sound like a pretty run-of-the-mill economist, but it depends, right? It's when you think about it at the index level, the fact that small caps tend to be more economically sensitive seems to outweigh that they have more domestic revenue exposure and should have less impact from the tariffs. And so I think it's, you can think of it as like, hey, it's great that you're insulated to a certain extent because you're trading amongst yourselves as a small cap company. But the thing is that if your country's economic picture is deteriorating, that's going to more than offset the benefit you have of being insulated from that tariff impact. If I think about the last round of tariffs, which is like relatively recent, right? The Russell 2000 underperformed the S&P 500. And, I think if I think one level beyond that, it's when you remember that the Russell 2000, that 40% of it isn't even profitable, I think you can make an argument that you should be owning small cap as part of a balanced diet. Absolutely, I agree with that. But it's just not a space that you need or want to own passively. You need to be able to X out a lot of these lower quality companies that just don't have any business being in your portfolio.
So if I could, one of the attendees asks a great question. What do you see as the catalyst for small caps?
It's always going to be earnings. That's, I think the reason why we've had this level of underperformance and this gap in valuation is just a function that the earnings really hasn't been there for small cap. Whether it's been they haven't been able to have the pricing power to pass off the inflation that we experienced, whether they were more negatively impacted by higher labor costs. It's also just the makeup of what's in the Russell 2000. You have a lot of banks and real estate that's really been struggling over, the last period. That said, I think there are still so many good quality companies that are in the small cap space that have not had an earnings recession. And, their multiple reflects that, of course. But I think you can own these good quality businesses. It's just a function of you have to do the work to find them.
Okay. And Julie, let me ask you, again, I'm going to paraphrase a question from an attendee. When you think about the possible range of values for earnings in the S&P 500 this year, how dramatically does that change based on potential Fed cuts? And I guess I'll ask you, do you believe we actually need those cuts?
I think for the S&P 500, it's less meaningful than it is for small cap, right? Because so much of the debt that's in the S&P 500 is fixed. Now, some of it is obviously coming due, and if it's at higher rates, that's going to be punishing for them. But it's much more impactful on small cap, where most people are impacted by variable rate debt. So there's a little bit of a dynamic in that way. And I would say, if I think about the tools that are available to us if we have economic headwinds, to me, it doesn't make sense to kind of prophylactically cut rates in the near term before we have any kind of indication of a recession. And I think that because we have a very high level of deficits already, we have the level of deficits that's consistent with, 7% unemployment, not 4%. And, the Fed is pretty limited in its tools that it has in order to be able to counter a recession. The other thing, too, is that if I think of the posturing of the Fed, if I think of who Chair Powell's heroes are, it's Paul Volcker, right? And I think for them, they would much rather err on the side of, I'm going to make sure that inflation is for sure dead and gone, rather than, being able to lower rates dramatically ahead of schedule or before we really have strong confirmation that we've really kicked it. And I assume that they will, just like they kind of overshot in terms of on the way up, that they'll undershoot on the way down. But the thing that I think is really important, like critical, is to just recognize that we're probably not going back to zero, and that most of the investment population is really been in existence with either ultra low rates or rate cuts. And so that's a different regime when your neutral rate is much higher than it had been historically. And I don't know how many investors are really thinking about that in terms of what that means for equity valuations, kind of corporate structures and of their debt financing. And I think that's just important to factor in.